Good morning. The committee will come to order. Thank you all for being here. On October 26, 2011, as part of its overall approach to comprehensive tax reform that lowers rates and broadens the base, this committee released a discussion draft aimed at modernizing our outdated international tax rules. The draft included a structure that would allow the U.S. to move from a worldwide taxation system to a participation exemption system similar to that used by almost all of our major trading partners. In the interest of transparency, we made a specific request. We actively sought feedback from stakeholders, taxpayers, practitioners, economists, and members of the general public on how to improve the draft proposal. Since then, we have heard from a wide range of practitioners and worldwide American companies. Nearly all have offered a universal observation. Having the highest corporate rate in the developed world, along with an outdated international tax system, is a barrier to success that leaves our country falling further behind our foreign competitors. Academics and economists agreed and also cautioned that any solution to these challenges must protect against erosion of the U.S. tax base through the shifting of profits to low-tax jurisdictions. Their concern is not without merit. Oftentimes, multinational businesses reduce their tax liability by separating the jurisdiction in which income is booked for tax purposes from the jurisdiction in which the economic activity occurs. The result of these practices is erosion of the tax base in a jurisdiction where the activity takes place. We've all heard and read about these practices, as we will hear today. The commentary on these practices varies greatly. As policymakers engaged in the tax reform debate, it's clear that there is no perfect system for taxing corporate income. But it's also important to bear in mind that these activities are fundamentally the consequences of bad laws and not necessarily bad companies. In my mind, the fact that the current tax code allows companies to achieve these tax results strengthens the case for comprehensive tax reform. Where their country has a hybrid system similar to the current United States worldwide system or a dividend exemption system like that of our major trading partners, it's important to develop strong base erosion rules that protect against aggressive transfer pricing, anti-migration of intangible property overseas, and foreign earnings stripping. And let me just say that it is important to remember that the most effective anti-base erosion rule is a lower corporate tax rate. But unfortunately, while a lower rate is necessary, the rate alone is not sufficient. Mindful of the need to develop meaningful protections of the U.S. tax base, the International Tax Reform Discussion Draft included 3 options to mitigate U.S. base erosion. Although the merits of each option remain open for debate, Option C, the carrot and stick proposal, received and continues to receive the most support from the business community. And our close work with the staff of the Joint Committee on Taxation leads us to believe it's an effective safeguard. Under Option C, all foreign income attributable to intangibles, whether or not owned by the U.S. parent or a foreign subsidiary, would be taxed by the United States at a substantially lower rate of 15%, minus any credits for foreign taxes paid on the same income. This approach provides a deduction for income related to intangibles kept in the United States, the carrot, and an immediate inclusion for income related to intangibles held abroad, the stick. In other words, companies would feel less pressure to shift income to low-tax jurisdictions because that income would be taxed at the same rate whether it's earned in the United States or Bermuda. The result of this approach would be that moving intangibles to tax havens would have little or no appeal, since the income earned from those intangibles obviously would be taxed at the same rate regardless of location. In fact, some companies have said that intangibles which have already been moved to tax havens under our current system could actually be moved back to the United States because there would not be any tax advantage to owning them abroad. The U.S. is not the only country concerned about base erosion. We'll hear testimony today from the OECD about its base erosion and profit-shifting report. As noted in the report, every jurisdiction is free to set up its corporate tax system as it chooses. However, the OECD's attention to this issue underscores that concerns about base erosion exist globally and must be considered as solutions are developed that are unique to each country's tax system. As I said at the outset, there's no perfect solution, and all systems have problems with base erosion. Our task is to develop a system that is more in tune with the global marketplace and that will allow domestic companies to prosper while simultaneously protecting the U.S. tax base. Comprehensive tax reform that includes a more modernized system of international taxation coupled with a lower rate, can create the climate necessary for those companies to prosper, invest, and hire here at home. I will now recognize Ranking Member Levin for his opening statement.
Thank you very much. Good morning, and thank all of you, the three of you, for coming to testify today on this important subject. I'm glad we are looking at the issue of international taxation today. I believe it highlights the need for tax reform to be about so much more than just lower rates or labels like worldwide and territorial. We live in a global economy. That is not going to change. There have been and will continue to be major benefits from globalization, which has occurred more rapidly in recent decades than in all previous ones combined. It has been furthered by dramatic new technologies that quickly spread beyond national borders. But globalization often can spread its benefits in very uneven and sometimes harmful patterns. Indeed, it presents increasing challenges to tax policies, and that is why we're here today. That is what we must confront, and it's the crux of what we're discussing, as I said, here today. Entities that truly have a home base in our nation and experience the many benefits and advantages as a result are using their presence or their pro forma presence in other places to lower their tax bills. Often the effect is so dramatic that it is difficult for the average taxpayer to believe that such tax avoidance is legal. The fact that it is and is widespread only highlights the urgent need to confront it. That truth was on vivid display last month when the Senate Permanent Subcommittee on Investigations revealed the complex structures and intragroup transactions that some multinational corporations employ in order to shift profits offshore in an effort to avoid U.S. taxes. The investigation illustrated how Apple's international tax planning techniques have enabled that tax giant to dramatically lower its tax bill. One example showed how an Irish entity established by Apple Inc. received tens of billions of dollars of income with no tax residence and as a result paid no taxes. Other major corporations like Microsoft, HP, and Google have also been shown to use legal tax avoidance techniques to shift income overseas to lower their U.S. tax liability. But as we'll hear today, the problem is not isolated to the U.S. Jurisdictions throughout the world, particularly European Union member nations, are realizing that companies are engaging in complicated structures that often have no economic value or substance, simply to avoid taxes. The response is anger from businesses that compete to citizens who are facing deep cuts in important government programs. The challenge of ending massive tax avoidance must be at the forefront of any tax reform effort worth its salt. I believe that will be confirmed by today's testimony. No country can compete with a 0% tax rate. Any tax reform must end the use of loopholes and base erosion techniques, including addressing how to curtail the shifting of jobs and profits offshore. Our current tax code creates incentives for multinational enterprises to shift money overseas, and with that money goes jobs. The days of so-called stateless income and double non-taxation must end. We cannot participate in a global race to the bottom that results in taxing jurisdictions being the big losers. Our tax code must not only promote American competitiveness at home and abroad, it must also promote domestic job creation that strengthens economic security for workers and businesses here in the U.S. Reform of our international tax rules cannot be done on the backs of small businesses, domestic companies, and individual taxpayers. So all of us on this side, and I think throughout the committee, look forward to hearing from the witnesses and learning more about your ideas to reform this area of the law. All of us appreciate the time and resources you've spent to help inform this committee on this complex and sometimes opaque area of the tax law. This discussion is an important step in reforming our international tax system. Thank you.
Thank you, Mr. Levin. Now it's my pleasure to welcome our panel of experts, all of whom bring a wealth of experience from a variety of perspectives. Their experience and insights will be very helpful as our committee considers the impact of federal tax reform on tax havens, base erosion, and profit shifting. First, I would like to welcome Pascal Saint-Amand, Director of the Center for Tax Policy and Administration at the Organization for Economic Cooperation and Development based in Paris, France. Second, we will hear from Edward Kleinbard, Professor of Law at the University of Southern California School of Law in Los Angeles, California, and a former Chief of Staff at the Joint Committee on Taxation. Welcome back to the committee, Professor Kleinbard. And finally, we will hear from Paul Osterhuis, a partner at Skadden, Arp, Slate, Meagher & Flom here in Washington, D.C., and a widely recognized authority on international tax issues. We welcome you back to the committee as well. Thank you all again for being with us today. The committee has received each of your written statements, and they will be made a part of the formal hearing record. Each of you will be recognized for 5 minutes for your oral remarks, and Mr. Saint-Amand, we'll begin with you. You are recognized for 5 minutes.
Thank you, Chairman. It's an honor to testify here today as the Director for Tax at the OECD, which is an international organization. The US is a prominent member of this organization, which includes 34 members overall. We do tax at the OECD primarily to eliminate double taxation. As you know, when you have cross-border investments, they can be taxed at source in the country where the operations are taking place, but also at residence where the headquarters of the multinational company is based. And as a result, you may have tax at source and at residence, and this is no good for cross-border investments that all countries need in free trade environment to foster growth and to foster jobs. And for decades, we've been working on eliminating double taxation by providing a model tax convention on which countries draw when they negotiate bilateral treaties, as the US is doing. We also do some economic analysis, and we recently issued reports trying to see what are the merits or the lack of merits of different taxes. And definitely corporate income tax is not a pro-growth tax. And what has been recommended from this analysis is that lowering the rate and broadening the base would be more favorable to growth than having very high rates. And I must recognize that the US now, after Japan's recent move to lower the rate, the US has the highest rate for corporate income tax, which is 35%, not taking into account the local rates. The state's rate is the highest in the OECD. What has happened over the past few years, I would say 3 to 4 years, is a growing concern in all OECD countries, and these goes beyond OECD countries to include what we call the BRICS, Brazil, Russia, India, South Africa, China, and some others, about what we now call base erosion and profit shifting. And that's why the OECD was asked by its member countries to launch this project on BEPS, to put an end to what countries identify as double non-taxation. We've moved from removing double taxation to an environment where the international rules articulated with domestic legislations might result in growing double non-taxation, as Chairman, you've just explained. And the OECD has been asked to look at the reasons why we have come to that situation. These concerns, of course, have been growing because of the crisis. I mean, the financial crisis turning into a fiscal crisis, turning into a political crisis, in some countries a social crisis, with the growing awareness that there is an issue with domestic companies not exposed to international transactions paying an effective tax rate which is close to the statutory tax rate, where some other companies exposed to international transactions can reduce their effective tax burden to very low rates. I mean, 3, 4, 5% of effective tax rate for a number of companies. And this is a global issue. It's not a US issue that's portrayed by some in Europe, for instance. It's something that you find in all countries, including in European countries. The OECD project is about trying to put all the countries together to try to identify what type of solutions can be brought to this global issue. And the solutions are not about any kind of harmonization, because the world is made of tax sovereignties and every country decides on its own sovereignty. But countries cannot ignore the spillover effects of what they're doing, or a single country cannot address the whole issue, otherwise it would put its own businesses at a competitive disadvantage. And I think that that can be the value added of the OECD, to make sure that all countries know what the others are doing and may benefit from best practices. And this is why we have issued this report, which is annexed to my written testimony, which is the report on base erosion profit shifting, which was issued in February. And since February, we have developed an action plan, which will be ready and published in July, and then reported to the G20 finance ministers on the 20th of July when they meet. And the action plan will consider a number of areas where actions could be taken, meaning developing some guidelines or some models, as the OECD does, letting, of course, the countries decide whether they want to draw on that or not. And within the actions, there will be something on control foreign companies, which is what you are trying to address in the draft. So I will be very happy to answer any question you may have on this action plan. Thank you, Chairman.
Thank you. Second, we'll hear from Edward Kleinbard, Professor of Law at the University of Southern California. We certainly look forward to hearing your testimony, Mr. Kleinbard. You have 5 minutes.
Thank you. Chairman Camp, Ranking Member Levin, distinguished members, multinational firms today engage in large-scale base erosion and profit shifting, what I call the generation of stateless income. This committee's international discussion draft was sensitive to the problems posed by stateless income strategies, and this hearing demonstrates your interest in protecting revenues from the spread of what might be called unprotected territoriality. But the problems have been underestimated, and stronger anti-abuse measures are required. For example, one recent study found that 54% of U.S. firms' foreign income is taxed at effective rates below 15%. And 37% of foreign income enjoys tax rates below 5%. My current research project, for example, looks at Starbucks, a classic bricks and mortar retail operation that deals directly with customers at thousands of locations around the world. Yet it appears that Starbucks has successfully reduced its foreign tax liabilities to surprisingly low levels. To put matters bluntly, if Starbucks can organize itself as a successful stateless income generator, any multinational firm can do so. The recent Senate PSI hearing focusing on Apple raises similar concerns. To me, the most remarkable aspect of the hearing was the baldness of Apple's tax planning. In effect, in 1980, Apple created a shell company in Ireland, capitalized it, and executed a contract on behalf of itself and this subsidiary, in which the subsidiary returned to Apple some of the capital ceded to it a moment before, and thereby purportedly acquired ownership in all of Apple's intangible assets outside the Americas. My description obviously simplifies the facts, but captures the essence of the story. Now, no one likes the current international tax rules, but the debates about a replacement have been marred by some recurring myths and misunderstandings. I wish to address just one of these. Intuitively, it seems sensible to argue that when our multinationals employ stateless income technologies to minimize their foreign tax liabilities, we should cheer rather than criticize. But this is false. In fact, that apparently foreign income often is U.S. income traveling incognito. What's more, the stream of tax-free foreign income encourages U.S. firms to engage in tax arbitrage by leaving all their global interest expense in the U.S. parent, where it reduces wholly domestic taxable income. Further, the prospect of stateless income distorts investment decisions by offering U.S. firms the possibility of realizing supersized returns on their foreign investments, what I call tax rents. And finally, promoting our national champions to avoid other countries' taxes leads to the mirror image response from those other countries, and a beggar thy neighbor race to the bottom, where multinational firms are the only winners and every taxing jurisdiction the loser. While I applaud the committee's inclusion of anti-abuse rules in its discussion draft, I am concerned that none of them, including option C, will work very well or be administrable. What then should we do? Many recommend a territorial system with some form of anti-abuse constraints, what we now call a hybrid system, but I believe that there is a simpler alternative that is more resistant to tax gaming, that in fact is competitive, and it makes economic sense. Genuine worldwide tax consolidation, just as we do for financial statement purposes, combined with a corporate tax rate squarely in the middle of the pack, let's say 25%. This idea is less wacky than you might think. The economic effects of worldwide consolidation are basically the same as a territorial tax with a 25% worldwide minimum tax as an anti-abuse measure. True worldwide consolidation is competitive with the tax environments that foreign domestic firms face in the countries in which they actually do business. By contrast, current law, or alternatively unprotected territoriality, heavily subsidizes foreign investment at the expense of our own domestic economy. Finally, every U.S. multinational firm should be required immediately to publish a worldwide disclosure matrix of its actual tax burdens by jurisdiction. Tax transparency rules are not a substitute for substantive international tax reform, but they would enable tax authorities to identify patterns of possibly inappropriate income shifting, thereby making better use of limited audit resources. A transparency principle also would awaken the public to the massive amounts of international tax avoidance today known only to specialists. Thank you, Mr. Chairman.
Well, thank you very much, Mr. Kleinbard. Mr. Osterheis, you are recognized for 5 minutes.
Thank you. I appreciate the opportunity to be here. We've had a lot of catchy phrases and indeed some fairly boisterous hearings on both sides of the Atlantic on this issue over the last several months, and it's a welcome to have a more considered debate here and discussion of a topic that's very difficult and very important. We're building here a set of rules that we hope will be enacted this year or next year that will replace rules enacted in 1986 that lived for 27, 28 years, and they replace rules that were enacted in 1962 that lived for 24 years before they were revised. So we are planning for the very long run here in trying to change these rules, and that means, to my mind, we have to be very careful what we do, because we can cause distortions in the economy in our effort to try to fix other distortions in the economy when you're planning something for this long run. Income taxes are, for most successful companies that are multinationals, probably the largest single non-cost of goods expense that they have. It's not at all surprising that they devote substantial resources to minimizing that tax in the interest of their shareholders. They ought to do that. We operate, and other countries operate, under a system of what we call arm's-length pricing. That rewards activities, yes, and it rewards financial risk, financial investments, financial costs. For example, with R&D, which is one in other product development costs, if you are bearing the risk of those costs in a particular jurisdiction under those principles, that jurisdiction deserves a reward if you're successful. We've talked today about many successful companies, and the other hearings focus on Apple and Google. We don't see much attention spent on Wang or on Colonet Software, my first software company that died. It was a great company back in the 80s, or Atari, or even AOL, or other companies who may well have used these strategies but had them backfire on them because they booked costs in low tax jurisdictions where the deduction wasn't worth very much, rather than booking them in high-tax jurisdictions where their losses at least could be bought by somebody else if they went bad. So governments are joint venture partners of governments imposing income taxes are joint venture partners with companies. And companies obviously, if they think they're going to be successful, prefer to have a joint venture partner that's going to take a small share of the profits and a small share of the losses than a high share. So they prefer to move their investments and, to the extent they need to, their economic activities to lower tax jurisdictions rather than high tax jurisdictions. There's nothing surprising about that under present law. There's nothing evil about that under present law. The other feature of present law is that arm's-length pricing is not a science. You don't have a determination of a price that is the right price. Arm's-length pricing is a range. And in many cases, it's a very broad range. If I had time, I'd tell you a few stories from practice about how broad that range can be, even when it's countries like the U.S. and the U.K. trying to decide the right price. And when there's a broad range like that, it is not surprising that the companies would bias their transfer pricing so that the favorable side of the range would end up in the low-tax country and the unfavorable side would end up in the high-tax country. And that's true whether the country is the UK or the US or France or Japan or anywhere else in the world. So it's a natural outgrowth of the system that we have had for the last 40 years. As income has become more dependent on intangibles and not dependent on bricks and mortar and equipment, as the kinds of products that get high value have low transportation costs, pills, software, things like that, this tendency has grown, and that's why we see numbers that has grown so much over the last few years. The pendulum, in my judgment, is at its peak. Governments are now waking up to it. The IRS woke up to it a few years ago and established a new unit in LB&I to centralize and expand their transfer pricing enforcement, and I think that, from a government's perspective, holds substantial promise. Obviously, other countries are starting to do the same thing. They may be a little behind the IRS, but they're starting to do the same thing. So we shouldn't just look at the pendulum at its peak. We should look at the longer run, because we are talking about a system that we want to enact and to last for 25 years. With that, I'll be glad to take any questions.
Well, thank you very much. Mr. Simons, a couple of times in your testimony you mentioned that the base erosion by multinationals could actually place small businesses and other purely domestic companies at a disadvantage. Could you just expand on that a bit for the committee, please?
Thank you, Chairman. Indeed, when you look at the effective tax rate of companies, which is the effective tax burden that they face, it looks like in most of the countries, if not all the countries, the multinationals, which are exposed to international transactions and therefore can play with the different gaps which are there through transfer pricing rules, tax treaty rules, and domestic legislation, they are exposed to a much lower effective tax rate than domestic companies, which cannot benefit from these international instruments. And therefore, this gap is quite significant, putting domestic businesses at a competitive disadvantage, and this is a distortion which doesn't sound good from an economic perspective.
Thank you. Mr. Osterhuis, is there something unique to the United States, because unlike many other countries, we have such a large segment of our economy in intellectual property? Is there something about that in intangibles that makes this a more important issue for us than for some other countries?
Yes, and I think it makes it a more difficult issue. Why we have, why Google and Apple and Microsoft are all U.S. companies, I can't tell you. I'm delighted that they are, but I can tell you that their competition is not just domestic. I mean, Apple's main competitor is Samsung. HP and has huge competitors in companies like Lenovo and Canon. Our pharmaceutical companies' main competitors are companies like Novartis and Glaxo. Even in the consumer products, Procter & Gamble's one of their main competitors, Unilever. Mars is Nestle. So we're dealing with a lot of U.S. companies that are successful, but a lot of their main competitors are foreign. They operate under territorial systems. And they have governments that see them as champions. For whatever reason, we don't see our multinationals as champion in the same way that the UK sees Glaxo, or that Switzerland sees Nestle, or that China sees Lenovo. Why that is, I'm not sure, but I think we need to be careful when we do things to our multinationals that are quite different than what their competitors are having done by their home countries.
And you've also observed that option C in this chairman's discussion draft that's been out there approaches neutrality between the development and manufacture of products in the U.S. and those activities that take place abroad. Now, can you explain how you think that's the case and what kind of behavioral responses we might expect to see from companies if option C were actually enacted into law?
Sure. The advantages of option C, to my mind, start from the fundamental point that they differentiate products sold into foreign markets from products sold into the U.S. market. To the extent we worry about base erosion, to my mind, in a territorial world, it is largely a concern with respect to products being sold in the U.S. market. That's where there could be incremental base erosion in a territorial system, and from a revenue point of view, you really have to worry about that. If you're going to do something like Camp C for products sold back to the U.S. and tax foreign affiliates on that income at normal rates, which is what Camp C does for the IP profit, the intellectual property profit, you may need transition rules, and we can talk about that. But that will help any revenue hemorrhaging and will help any real base erosion of the U.S. tax base for U.S. products. For foreign products, it's quite a different situation, because for foreign products, in most of these businesses, they are consumer-facing businesses, and so the country where the products are consumed has a large right to tax that income. You'll notice in Europe some of the outrage that's been raised lately, particularly in the UK, has all been focused on inbound companies, whether it's Starbucks or Google or Amazon. It's all inbound companies and their income in the market country. And what Camp C does is recognize that we have a much lesser right, if you will, to assert jurisdiction to collect revenue out of that income, and I think that's a very sensible distinction over the long run. The other thing that Camp does through the carrots, as you described it in your opening statement, is to try to come closer to neutralizing where you locate your manufacturing plants and other similar activities. I think there's more than one way to do that, but I think the goal, while you're differentiating between products that are sold for foreign markets and products that are sold for the U.S. market, if you could try to do measures like Camp C does to neutralize where you manufacture those products, I think that would be an important goal, and that's what Camp C is trying to accomplish.
All right, thank you. Mr. Levin's recognized.
Thank you, and again, welcome. I just want to say, Mr. Saint-Amand, I'm glad you talked about effective tax rates, because when we look at the corporate tax rate, we really need to look at the effective rate as well as the other rate. And let me just say, Mr. Oosterhuis,
Sure.
We're proud of American corporations. I think we have as much pride as Europeans. And so when we talk about tax policy and we talk about how our companies utilize them, it's not because we're not proud of them. It's because we very much want to have a tax system that makes sense for all of us. And I hope that isn't misunderstood. I'm hopeful that we can have, this is such a useful hearing, a lot of discussion among the three of you. So I want to start off, and so maybe we can get you talking with each other, maybe even arguing a bit. So, because this is so important. So I'm sure my colleagues will pick up and take other pieces of your testimony and have you comment on the others, because we don't do enough of that. So I want to read for you, Mr. Kleinbart, a sentence or two sentences from your testimony, Mr. Oosterhuis, and ask Mr. Kleinbart to comment, and then maybe one of my colleagues will ask you to comment on his comments, okay? Because I really want to understand it. I think this is critical to are getting at this important issue. So this is from the last page of your testimony. And Mr. Kleinbart, I'll read it to you, though you can see it in his testimony. Mr. Oosterhuis concludes, I would suggest that a corporation's place of residence or the location of its activities or how much foreign tax it pays are not likely to provide useful and certainly not complete, it's modified a bit, measures of profit shifting. A focus that is geared towards the location of sales and matching of income and expenses is far more likely to produce useful measures of and thus productive solutions to the issue of U.S. profit shifting and base erosion. So I didn't tell you I was going to ask this, so we have lively discussion. If you would analyze that from your perspective. And don't pull any punches, okay?
Unlike my usual practice. Okay.
Yeah, he's never been known to do that.
I know that. We
So-
know each other well, all of us know you.
There's a lot bundled in those thoughts of Paul's. Let me begin by observing that there, at least in my view, is a fundamental conflict between the idea of looking to the place of sales on the one hand and the policy recommendations that are contained in Paul's testimony on the other. In my worldview, we ought to end up with knockdown, drag-out fights all the time between the country of residence and the country of what I call source, or the market country, where things are actually sold. That's not what we have today, and that's not, I think, what a world in which cost-sharing agreements are given primacy would lead to. Those lead, in fact, to a siphoning off of revenues neither to the home country nor to the source country. That's the point of the Apple hearing, was not that income was being taxed where the sales were. Income was being taxed nowhere. So there is a natural tension. The United States is a great generator of intellectual property, as Paul identified. And the United States may well want to consider carefully whether moving to a destination-based tax system is net a revenue loser or a revenue gain for the United States. We're the largest single consumption base in the world, so we would pick up revenue from that perspective. We lose revenue from the other perspective because we would treat sales from intellectual property developed in the United States to customers outside the United States as having no U.S. tax liability associated with it at all. So, to my way of thinking, there is this important tension between the sentiment and the actual recommendation. There's a very mixed message, I think, as to what is in the best interests of the United States. Finally, we should not forget the fact that although we have open capital markets, although we have an open economy, the fact is, the last time I looked at the statistics, 84% of U.S. firms are owned by U.S. individuals, ultimately. And so there is an identity between U.S. firms and U.S. individuals. That's not true in the U.K., for example, where the percentage is much, much lower. That's why I see taxing the U.S. firm on a worldwide basis as pretty good substitute for taxing U.S. individuals on their share of the capital income thereby earned.
Thank you.
All right. Thank you. Mr. Brady's recognized.
Thank you, Mr. Chairman. Testimony clearly reveals the need to fix this broken tax code to make America far more competitive, make our workers far more competitive around the world. Mr. Oosterhuis, I want to talk to you about a hybrid system. It seems like the current system we have today makes it difficult for when an American business competes around the world and wins, when they attempt to bring those profits home to reinvest in America, they oftentimes find themselves paying a huge premium to do that. And my question is, should we move to a hybrid system, in effect an investment-neutral system, where companies that compete around the world and make profits, rather than have them stranded, that there would be a lower tax gate so they can reinvest in the U.S. R&D jobs, in manufacturing plants, in dividends that go to shareholders, middle-class families, that those are all positive things for the U.S. economy. Can you tell me how you view the current code, and would an investment-neutral type system that would allow those stranded profits flow back to the United States help make us more competitive?
Sure, happy to. And you're absolutely hit on the point that I think some of the base erosion profit split discussion has sidetracked us from keeping a focus on, is that the most broken part of the system as it is today is the fact that your non-U.S. earnings have to stay, if they're low tax, have to stay outside the United States, and you can't bring them back. We need to eliminate the system that forces companies to leave their income offshore. Ed, in his testimony, mentions that in Apple's case, it's not a problem because they can borrow $17 billion. Well, not every company is Apple, and indeed Apple wasn't Apple 10 years ago either. And so most companies don't have the flexibility to do that. I do transactions every day. I have 2 this week with foreign companies and U.S. companies buying or selling stuff. The most important thing is, can I use my offshore cash to buy? And if I'm going to sell, am I going to get those proceeds offshore or onshore? Because cash that is offshore for a U.S. company that would have a high tax cost to come back is a wasted asset. It doesn't help your profit and loss statement. You can't pay it out to your shareholders. You have to find some effective use for it, and that leads people to pay more for things that they can buy. If they can buy it with foreign cash, it distorts the economy. As foreign earnings have grown over the last 5 to 10 years, it has become a very large problem, and we need to fix that. So however hybrid the system needs to be in order to satisfy base erosion concerns, that will likely be better than what we have today with deferral, okay? Because the deferral system is really causing some serious problems.
So if we keep the current system worldwide with a complicated set of provisions to try to offset some of that, do you think that problem continues to grow?
Absolutely.
That those investment decisions continue to be distorted
Absolutely.
in the future? And done right, a hybrid system could make us more competitive.
A hybrid system that doesn't do what Ed proposes, in my judgment, which is tax U.S. multinationals at the full statutory rate on their global income, but is more hybrid than that, has elements of territorial in it, I think can be a real plus from a competitive perspective for our multinationals, and can be designed in a way that minimizes some of the issues of base erosion and profit shifting that we're talking about today.
Well, it just seems to me, finishing up, 95% of the world consumers are outside the United States. We want our companies competing in every corner of the globe and winning, and we want them to have the ability to reinvest those dollars back in the United States for our jobs, for our research and development, for our manufacturing, in order for our economy to grow stronger. So I think that ought to be a focus of where real reform heads. Chairman, thank you.
Thank you. Mr. Rangel is recognized.
Thank you, Mr. Chairman, and thank all of you for taking the time out to share your views with us. Mr. Kleinbond, you have a reputation of not pulling punches. Everyone agreed on that. And, of course, the great job that you did for the Joint Committee was certainly bipartisan, so I expect that a lot of that bipartisanship will still be with you. When you find complete accord with everyone that's reviewed our present tax system, that we have to eliminate unfair loopholes and broaden the base and reduce corporate taxes and to have our firms creating jobs here, and since we have known this and that objective appears to be bipartisan in nature, and even to the extent that the private sector, in terms of wanting to know how to plan, have advocated publicly that we should reform the system, why in the world do you find, regardless of which party is in charge, that there doesn't appear to be any sincere movement to make that a priority?
Mr. Rangel, you are asking a political question, and the inner workings of the political system, despite my close study for many years, has always been a bit of a mystery to me. There ought to be movement. The current system is broken. The current international system is crazy, but more important to me, and frankly one of the oddest things to me about much of the debate on corporate tax, is that the domestic business tax system is broken. What we need in the United States is lower statutory rates, broader base, as Mr. Saint-Amand explained, that reduces distortions. The goal should not be to help U.S. firms compete around the world. That's just a subsidy by another name. We've finally learned after 100 years that trade subsidies don't work. And the same is true with tax subsidies. What we want is a robust, successful economy for the United States of America. And the way to get that is to improve the business tax system and to lower rates and broaden base. We can't afford to lose revenue, in my view.
Is your answer, Professor, that it is a mystery to you?
It is a mystery to me as to why more progress has not yet been made. Yes, sir.
Does anyone else have any type of answer that you, because I'm under the impression that the power of the multinationals that are enjoying this tremendous tax benefit is overwhelming, and that people fear politically of interfering with these corporate desires. Does anyone have any views on that at all? And I hope I'm wrong. Yes, sir.
I'm not sure I will respond exactly to your question, but I think what both governments and businesses have in mind is to what we call leveling the playing field.
Yes.
Making sure that companies from one country are not at a competitive disadvantage vis-à-vis companies of other countries.
Yes.
And what has happened over the past 20 years, I think, even though it's subtle and it's implicit, is that high tax countries, at least in corporate income tax, and there the US is a high tax country in terms of corporate income tax, as well as a number of European countries, they have kept the high tax probably for, visibility reasons, but they have organized a system where companies don't actually pay the statutory rate. In many European countries, which are territorial system, but still they have CFC.
I'm sorry to interrupt, but one would know, even if your assumption is correct, that is totally unfair to the companies that are paying the real tax rate. So that's an expansion of the degree of the problem. Mr. Osterwitz, do you have any views on this?
Well, the one thing I would say, Mr. Rangel, is that I think the multinational community is more ready to embrace tax reform, even if it involves some pain for them, than they have been in the last 20 years.
They have said that.
And I believe it, because I see what happens. I see what happens with CFOs. I see what happens in boardrooms and how the distortions that the current system is coming
So you mean
causing.
everyone's in agreement that we should do it, the corporate world?
It's certainly not companies that are keeping it from happening.
And politically, you can't think of any reason why we shouldn't do it.
All right, time has expired.
Agreed.
Thank you. Mr. Teaberry is recognized.
Mr. Osterhaus, you mentioned some American worldwide companies and their competitors, mostly being foreign competitors. I constantly hear from CFOs of many of those companies that they have trapped cash abroad, whether they are selling diapers, widgets, cylinders. Is that a function of our U.S. tax system today?
Absolutely. It's a function of the deferral system that says if your foreign profits are taxed at a lower rate than the U.S., and the U.S. has a very high rate relative to most countries, that when you bring it back, you pay the incremental U.S. tax. So even your U.K. profits, we're not talking about Irish Dutch sandwich type profits, even your U.K. profits that are taxed now at 23% going down to 20% with a 10% patent box, if you bring those back, you have a huge tax cost. And it's not in your shareholders' interest that you do that and you bear that cost. Therefore, you leave the money outside of the United States, and it is, in that sense, trapped. And that is an economic distortion.
So if we went to a pure worldwide system, we don't have that today because of deferral, wouldn't that also disadvantage those companies, those American worldwide companies that are selling diapers abroad, widgets abroad, cylinders abroad?
Going to that system, to my mind, would be a huge gamble because you would be gambling with the competitive life of our multinationals. No other country does it. Foreign income now is taxed. I mean, Ed gave some of the tax rates. When you look at the averages these days that are effective, it's more like 17%. And so even at a 25% rate, you would be subjecting our multinationals to a very large cost that their competitors, whether it's Samsung, Lenovo, Glaxo, Novartis, they're not bearing that cost. And their countries are not interested in forcing them to bear that cost.
So theory might be great, but on the world stage, reality is different. And our companies that are selling diapers, widgets, and cylinders face a much different reality, right?
Correct.
So if we want to be competitive, because having a worldwide company in my district or in Mr. Reichert's district or Mr. Ryan's district, obviously the best jobs of the company are usually at the headquarters. I know that's true in Columbus, Ohio. I've been told by CFOs that our current system that we're under, where that trapped cash is abroad and competitors don't have that double taxation, that when you have a merger or an acquisition, even if it's in a U.S. multinational company acquiring a foreign company, that for shareholders it's actually to the benefit to invert or move the headquarters to that foreign jurisdiction, whether it be Ireland or Belgium or another low-cost jurisdiction that might have a different tax system. Do you see that?
We see it fairly frequently. There are definitely transactions that are under consideration all the time of U.S. companies and foreign companies combining. And when you look at those transactions with our rules as they are today, and even more so if we had a consolidated worldwide tax system, the only choice you would have would be for that resulting parent company to be a non-U.S. company, because the difference in the financials for the financial success of the company would be huge.
So we are really today, in reality, not theory, in reality, we're at a disadvantage.
We are causing ourselves a disadvantage by the way our system works today. That's right.
Do you believe the camp draft then on the international side, by lowering that rate, will stop that disadvantage and maybe even potentially turn some heads internationally that, hey, you know what, not only should we not move, but maybe we should actually look at the United States?
Well, if you take the camp proposal with option C, a variant of option C, you're certainly moving substantially in that direction. Yes, whether you get all the way there depends on the specifics of the base erosion provision, but and some other aspects of it. But you would certainly move substantially in the right direction.
Well, thank you. I yield back my time.
All right, thank you. Mr. McDermott.
Thank you, Mr. Chairman. I've been sitting on this committee listening to the fact that we need to reduce the tax rate to 25% on corporations, that would make them competitive worldwide. And now today we come and we hear this, and it turns out that really what you want to do is bring back this so-called trapped capital back into this country. Now, unfortunately, I've had the experience of sitting on this committee for quite some time, and I was here in 2004 when we repatriated. 843 companies repatriated $312 billion. They avoided $92 billion worth of taxes. 58 companies accounted for 70% of that. They saved $64 billion in taxes, and they laid off 600,000 workers. They paid dividends, and they bought back stock. Now, I'm trying to figure out, when you tell me that Apple and my local company, Starbucks, which we're kind of proud of in Seattle, and a few other places are doing quite well, but they got this trapped money over there, who is it that benefits from this untrapping, and what are they going to do? What benefit will there be to America? Starbucks is doing pretty good right now.
Yeah,
Apple's doing pretty good. All these companies are doing pretty good.
I'll start out, Ed. You can, to my mind, it's largely their shareholders. I mean, I think what most
So it's the
companies,
shareholders.
Yeah,
It's not the workers. It's not the
That's right.
economy of the country. It's only the shareholders. We're having a
I
shareholders
think it is
meeting
largely
today.
the shareholders, yes.
Okay.
Because a lot of that, there's two effects. One would be if the money comes back, it would be used to buy back stock, pay dividends in the first instance that are not being paid now. And I think that's healthy. That gets the money in circulation, and that will help the economy indirectly. The second aspect is that today, because of the trap cash, companies have more of an incentive to buy assets that are outside the United States than to buy assets inside the United States. It has to help us.
Let me just
if that
stop you a
bias
second.
is
Do you take
eliminated.
into account at all those 600,000 workers who were displaced by that activity? Does that
The
make
workers
any
weren't
difference?
displaced by the cash coming back.
Well, why was that part of the process? Why did they lay off 600,000 people in the United States when they're bringing all that money back here and supposedly investing it here? Tell me what that kind of investment looks like, because if you don't hire workers, I don't see what the investment is. Maybe I'm not an economist, so
And I'm not here to defend the provision that basically allowed companies to bring the money back and spend money that they were going to spend anyway, and then do what they wanted to with the incremental money that they brought back. That's the way that provision worked. And so in the end, most of the money ended up benefiting shareholders, not benefiting workers. But that was the way Congress drafted the provision. It's not surprising that it worked as it was intended to work.
So you would suggest maybe that we should put in provisions that would require them to invest it in things that produce jobs in this country, would you?
No, I
No.
think you should give them discretion to do with it as they see best for the company, and that will give them a level playing field about where they use the money or whether they distribute it to their shareholders for them to invest in other ventures, which may well be in the United States.
So with our own economy, we haven't done anything about poverty in this country. Poverty is about where it was, and we've got 2 million people less working now than we did in 2007. And you don't think that anything we do in this tax structure should have anything to do with job creation?
I would not recommend having something that is targeted towards job creation. When I was on the Joint Committee staff back in the 70s, when Mr. Rangel was a junior member, we drafted a credit for hiring in 1977. That didn't work very well, and those provisions tend not to work very well. You really are better off setting up neutral rules for businessmen to make business decisions, and hopefully that kind of transparency and lack of economic distortion will lead to growth in the economy.
Mr. Claiborne? I agree actually with a fair amount of what Paul said. Let me just, but there are a couple of important caveats. First, $100 billion a year is coming back right now. We have $100 billion a year of repatriation today. Second, the money is not trapped in the sense that it is excluded from the U.S. economy. The money is not buried in a backyard in Zug. The money is invested in U.S. banks and in U.S. government bonds, so it's at work in the U.S. economy today. Third, the U.S. multinationals that have this trapped cash have today the lowest cost of capital that they have ever had in a generation. They are not capital constrained in any way. Finally, where I do agree with Paul is let the money come back as part of reform. Don't try to micromanage how the money is used. It will go for stock buybacks, but tax the money, not at 5%, but at a higher rate, and use the tax revenues to fund programs that are designed to address joblessness, that are designed to address poverty.
All right, thank you. Time's expired. Mr. Reichert.
Thank you, Mr. Chairman. Thank witnesses for being here today. I'm fortunate enough to come from the same state as Mr. McDermott comes from. We have a number of international corporations, as you know, in Washington State that would be affected by these erosion proposals. And I've been following this base erosion issue with a lot of interest, and it's not an easy thing to really grab onto if you're not some sort of a tax expert or a tax attorney, but it seems to me like the goal here is to create a tax system where our companies are able to compete on a level playing field. And couple of the ways that all three of you have mentioned today is to lower our tax rate and broaden the base. That's sort of a common sense, I think, a logical approach, which hopefully brings money back into the country and creates jobs, I think. But what I hear you saying too is to let the free market work. Don't micromanage is what I've heard from all three of you also. So we all want, I think, Democrats and Republicans, is for our corporations to be competitive internationally and to pay the taxes they owe. To pay the taxes they owe. I mean, we've heard companies that are not paying taxes right now. So the testimony today, we've heard U.S. corporations that manufacture in foreign affiliates and then they sell their products back to the United States. And one of the main goals of the corporate tax reform is to put corporations on a level playing field, as I said. How do our competitors, such as the UK, who has recently changed its international tax rules, handle these types of transactions?
Thank you, Congressman. Over the past 10 years, just a fact for you, we have more than 10 OECD countries which have moved from a worldwide system to a territorial system. But at the same time, they have, most of them, it's not the case of the UK, they have strengthened their CFC legislations to make sure that you tax territorial, but you fight the delocalization of the profits in low-tax jurisdictions or in no-tax jurisdictions. The UK recently has lowered its corporate income tax, but has also changed its CFC legislation in a way which is not about strengthening it. However, overall, the countries, I think, agree. There is a consensus, and it's clear at the OECD when we have discussions with all the member countries, that all the countries care about putting an end to the divorce between the location of the profit and the location of the activities. Today, through the transfer pricing rules, the tax treaty rules, which were designed in a different environment, where, I mean, business was not global. You had cross-border investment, but it was not completely global. These rules have not kept pace with the way business operates, and that's why we have gaps which allow businesses to put the profit in a shell company where you have absolutely nothing else but funding and ownership, but absolutely no employee to develop the intangible and the real value of the company. And the project that we are pushing for, which I think is fully in line with the reform you're trying to introduce, is to try to put an end to this situation which unlevel the playing field between companies within one country and also between companies from different countries.
So we've been talking about option C, which we know is not perfect, but kind of gets us to that same point. Is that correct?
Option C does have what I would call a destination focus, in that it taxes offshore manufacturing with respect to sales back to the U.S., but at the full rate, but lesser so with offshore manufacturing for sales abroad. So it does have a destination focus. That's
let me ask one quick question. My time is winding down. One of the frequent questions that people have asked me about option C is, how do you define what percentage of income is attributable to intangible products?
This is one of the reasons why I think that option C, to sort of paraphrase Mr. Teaberry, maybe have a theoretical merit, but as a practical matter is impossible to administer. You are going to ask the IRS and companies to fight for the rest of their lives about what fraction of total income is attributable to which intangible asset. I think that this is a very unfair burden to put on the future system.
I would, if I could, disagree with that. Although there clearly is some burden anytime you do it. But if you take if you define intangible profit as essentially being an excess profit over a routine profit, which is what the administration tries to do in their excess profit bill, or their excess profit provision, that can be a pretty relatively administrable proxy for intangible profits because you're taxing the rents that Ed talked about.
All right, time's expired. Mr. Lewis is recognized.
Thank you, Mr. Chairman. Mr. Kleinborg, my district is home to a large number of corporations. Many of them are multinational and many more that are domestic. I strongly believe in order for our American companies to grow, they must be competitive, both at home and abroad. Now, the chairman has stated that he doesn't want a code that will pick winners and losers. In your testimony, you recognize there's something of a consensus around the idea of a hybrid system of taxation. If this system was adopted, would both domestic cooperation and multinational cooperation win? Who would lose?
In my view, corporations, multinational corporations must come to recognize that in any future system, whether it's called worldwide consolidation, whether it's called territorial, whether it's called hybrid, any system that accomplishes the policy goals that you all share is going to be one in which U.S. multinationals pay a higher tax bill on their foreign income. The only question is how much are they going to pay to the United States and how much are they going to pay to the countries in which they're really doing business. That is going to be a part of the revenue. How much is very hard to model, but it's going to be some of the revenue that gets you to the lower rate. The lower rate is going to be really important because it enables the domestic business sector to be competitive in worldwide terms, which is what you really want. You want a U.S. environment that attracts foreign investment into the United States, and you want one in which U.S. firms that are U.S. owned can in turn face tax rates that make their environment competitive with those around the world. Multinational firms will pay higher tax in the future, whether it's a well-designed hybrid system with an option C that works. I have great skepticism about that. Or whether it's worldwide, they will pay higher tax to somebody.
Well, thank you very much. Mr. Chairman, I yield back the remainder of my time to the gentleman from Texas, Mr. Doggett.
All right.
Mr. Kleinborg, there are millions and millions of dollars being spent to convince this Congress that the country will live happily ever after if we'll just let these multinationals bring back their $2 trillion from overseas and do wonderful things, fund infrastructure, do other things here in this country. The last time we did that, as you mentioned, we entitled the bill the American Jobs Creation Act, but as Mr. McDermott indicated, we lost 600,000 jobs. You have pointed out in your testimony that much of this allegedly locked offshore tax revenue, locked offshore money, is actually sitting right here in the United States. It's only a paper transaction away, and that money can be invested in the United States in infrastructure or just about anything other than paying dividends, corporate executive raises, and buying back stock, can it not?
That's absolutely right, sir. The money is in the U.S. economy. It's at work in the U.S. economy. It's just in the one place where corporate executives really, really, really want it to be, which is in their pockets.
In their pocket.
In their pockets, yes,
yes,
sir.
in their pocket and in the pockets of some of their shareholders.
Yes, sir.
But the money can be put to use now. What is really offshore is any payment of taxes. And the notion that we would let folks get essentially a tax amnesty, pay a nickel on the dollar without benefiting the United States economy as a whole and just enriching those who are already doing pretty well is a notion that strikes me as being very, very counterproductive.
And what's interesting is, in addition, is this is the only time you will ever confront an efficient tax in the technical economic sense. Taxing these old earnings does not affect future behavior. So by putting a reasonable tax on the old earnings, you are not incurring any economic efficiency costs. It'll be the only time this committee has ever confronted an efficient tax.
Thank
All
you
right,
very
thank
much.
you. Thank you.
Thank you, Mr. Lewis.
Thank you. Mr. Gerlach. Okay. Mr. Buchanan.
Yeah, I want to thank the chairman for this important hearing. I want to thank our witnesses for taking the time today. Mr. Kleinbauer, you had mentioned this idea, a worldwide tax. I don't want to oversimplify this thing, but I just look at these tax proposals and bills come up every 25, 30 years. You can see how far we've come in the last 25 years. I've done business abroad. I think about maybe we might not get to this for another 25 years. But my point is, it seems like to eliminate the trap cash and all these other issues, isn't the bottom line really with all this is to have a worldwide tax, giving some consideration for territories and other things, but it's got to be at the right rate. I think of Hong Kong, when I was there 20 years ago, they had a flat rate, no deductions, minimal deductions, 20%. Back there a year ago was at 16. Isn't really what we're talking about is that, the U.S. and the world has changed the last 20 years, thinking forward another 20, 30 years. We want to be paid on taxes from around the world, ideally, but it's got to be at a number that's competitive and makes sense, takes the incentive away from CEOs to work with their accountants, outside accountants, creative tax lawyers. And so I look at this as someone that's done business abroad and thinking about this a lot. We need to get to a rate that makes sense. And I want you to comment. You've touched on that, but I want to go back. Isn't that really what we're talking about, ideally?
Mr. Buchanan, I agree absolutely with everything that you've said. To be clear, a worldwide tax consolidation, to move to that, part of that would be to deal with the trapped cash. Whatever you do, whatever you all decide to do for the future, you need to clean up the past.
Well, we'll deal. Let's make the assumption. I'm worried about trapped cash in the future. We'll figure out how to get to that.
And a worldwide consolidation, as you say, does not have a trapped cash problem because you've paid your tax on it already. So, and I agree 100% that the only question really is rate.
And that's the question I want to ask you.
And that's why I said in my testimony that my proposal only works if you imagine that the U.S. rate is squarely in the middle of the pack, ideally even a little bit lower than that, so that a U.S. firm can face in every country in which it does business a tax rate that is comparable to the domestic rate in those other major economies.
We have a 35% published rate.
And that's too high.
Effectively collect whatever, pick a number, 17%. But what do you think that number should be today? I'm going to put you on the spot.
Oh, that's no problem. 25% is, my bid is 25%.
Okay.
And I'll point out that there are a couple of countries like the UK that are a little bit lower, others a little bit higher.
Personally, I think that's high. I know that's where we want to go as a committee.
We can negotiate.
Opinion? Yeah. Mr. Osterhaus, I want to get your thoughts on this. I think at the end of the day, the way we eliminate this stuff going forward, we've got to have a rate that makes sense, that takes the incentive away from corporations that do business worldwide. But what's your thought on that? And then I want to put you on the spot. What should that rate be today so we don't have to game the system, somewhat game the system?
I mean, there's no question in my mind that 25% is definitely too high and risks the competitiveness of our companies over the long period of time. Rates have come down since the study that, in foreign countries, since the study that Ed referred to, and many countries have patent boxes now that actually lower their rates from their statutory rates. The UK is having a 10% patent box. We're also facing more competition from Asian companies that are taxed at lower rates in their countries, as well as having territorial systems. What rate would work? I think there's two aspects of that. One is what is the rate? I would say for foreign income, for U.S. income, obviously we've got to talk about maybe a 25% rate because that affects a huge amount of money. For foreign tax, if we're going to eliminate deferral and have a current tax like Camp C does, but at a lower rate, I would say somewhere between 10 and 15%. But I would also say you would need to make sure you give a credit on an overall basis for the foreign taxes that companies are paying. If you do that, then you will increase many companies, the most successful U.S. companies, taxes on their foreign income. You won't increase it on many companies that are not so successful.
Let me add it just because my time's getting up. I think at the 25% rate, I don't want to take anything away from the committee or anything, but I think the bottom line, we'll be back here again talking about the same things in the next 5 to 10 years because we're moving aggressively. 95% of the marketplace is outside the U.S. We've got to recognize that. That's the future, and we need to get to a rate that makes sense, and I think it's a lot lower than 25% to eliminate the gaming. And I yield back.
Time has expired, and the chairman thanks the gentleman from Florida for not taking anything away from the committee. Mr. Neal is recognized.
I hope my questions will add value to the conversation. Thank you, Mr. Chairman. Professor Kleinbard, you have spoken of your concern with stateless income earned abroad that isn't taxed anywhere. So let me discuss with you and ask you about something equally troubling, which is the stripping of U.S.-based income into tax havens to avoid U.S. tax. As you know, for the past several years, I've introduced legislation to address a competitive imbalance in the domestic property casualty insurance market that favors foreign companies over their domestic competitors. I'm not trying to hide the fact it's constituent-driven. In fact, the legislation was developed working with your staff while you were the Chief of Staff at JCT. A loophole in the current tax system allows foreign companies to strip their income overseas and avoid U.S. tax merely by reinsuring their U.S. written policies with affiliates located in tax havens. As you wrote in the last law review article, this provides them with, quote, the ability to invest long-tail P&C reserves in a tax-free environment. The ability to strip their earnings overseas and avoid U.S. tax on their investment income provides them with a significant advantage over their domestic competitors. Should our system favor foreign companies over domestic companies in serving a U.S. market, or should we restore a competitive balance by addressing this loophole?
You know, Mr. Neal, just because it's a constituent issue doesn't mean that you're not right. In this case, I think there is a policy problem.
I don't want anybody to be confused about.
There is a policy problem here.
There is a policy problem.
And the policy problem is, I think, unique to insurance. The problem is that reinsurance is a kind of way of doing business in the United States without getting your fingerprints on the United States, so that you're treated as not doing business in the United States. Reinsurance is a very interesting business. It's typically done by a long-term contract called a treaty. There's a season where everybody descends, literally everyone goes to Bermuda for a 2-week period to negotiate their reinsurance treaties. So it's possible to do a great deal, to take on a great deal of insurance risk with respect to the United States without getting your fingerprints all over the U.S. tax system and being treated as doing business here in the United States by virtue of the unique nature of reinsurance. And so I do think there's a policy problem there that could fairly be addressed.
Okay. I'm pleased you raised the issue of Bermuda because members of the committee that have been here for a long time, you know I tackled that issue back in the early 90s and had some success. But the former chairman of the committee resisted the idea of making the provision retroactive that we offered, and we were able to shut it down, only to discover that on the island of Bermuda today, there are still plenty of companies that insist that they have that they are a Bermuda-based company without economic substance. It's a real issue.
Yes, sir. I believe it. I agree. And it's unique to reinsurance because of this whole idea of the reinsurance treaty and a very short time period in which the treaties are negotiated enables U.S. risk to be taken on by firms without being technically treated as doing business in the United States.
And I had some success in leading the charge here on FACA as well, but I want to, based on what you've just said, Professor Kleinbard, I recently talked to Tom Barthold and his team at JCT about a difference between tax avoidance and tax evasion. As the former head of JCT, would you talk to me a bit about the differences between these two concepts?
Yeah, I'm obviously going to talk in my capacity as a professor of law. I have nothing special to say about JCT and its work in this respect. When it comes to corporate tax, when we talk about the kind of issues we're confronting today, I like to think of things in terms of a continuum of aggressiveness of behavior rather than avoidance and evasion. I frankly don't find those terms as helpful. The basic problem is that anytime you have fact-intensive issues, there is a mismatch between the corporate taxpayer and the tax authority. The corporate taxpayer can muster more resources, knows itself better, obviously, and can put more energy into a case. And so the systems that, unless they're very simple, it was one of the reasons I like worldwide tax consolidation. Unless the system is very simple, you're always going to have a mismatch in the energies that are brought to bear on a question between an aggressive firm and the IRS. That rewards aggressiveness in behavior. And as I say, I think of it as a continuum, but I think the right word is aggressiveness. And how aggressive is a firm? Today, firms really are, are self-reporting agencies. We rely very heavily on corporations to get it right in the first instance. You don't want a system that encourages more and more aggressive behavior.
All right, thank you.
Thank you, Mr. Chairman.
Thank you. Mr. Smith.
Thank you, Mr. Chairman, and thank you to our witnesses for sharing your insight and expertise. We know that the world economy and global economy is very diverse, and manufacturing might be very different from, say, agriculture, which I represent. Could you perhaps share your perspective on how the current U.S. tax system affects American agriculture producers internationally, and what the effects of changes proposed in the chairman's discussion draft would be on those?
I was in private practice for a long time, but I didn't have any direct experience with agricultural exporters. But I think the fundamental point is they ought to be concerned with rate. And anything that gets to a lower domestic rate is going to be in their long-term interests. And I think we have a consensus among the three of us that the U.S. statutory rate today is too high, and domestic business, including export business, is disadvantaged.
Thank you.
Yeah, I would agree with Ed on that. I think, we do have agricultural companies that are global. I seriously doubt that any of them would be accused of base erosion because their products are commodities, and so transfer pricing works relatively well in that world. But they do engage in tax planning like other U.S. multinationals do, and as they should. And so I think for some of those companies, the kinds of reforms that we're talking about today that would be a hybrid system of exemption and current taxation and get rid of the potential trap cash problem would be a constructive reform for those companies as well.
Okay, thank you. Any others wishing to comment? As well, what would you say is the experience of other countries who pursued repatriation alongside a shift away from worldwide to territorial, hybrid, or another system?
I'm not sure that other countries have been in the same situation as the U.S. I think it's a very typical U.S. situation because of the articulation of the very high rate, the check the box, and all the very U.S.-specific features. So to my knowledge, it has not arisen in other countries in the same terms.
Okay. Anyone else?
Well, I can speak somewhat, at least, for the UK. I mean, I think the UK has not only lowered their rates, and gone to territorial, but they actually limited their CFC rules in terms of their application to UK multinationals with respect to their non-UK income. And I think that's been a healthy thing for their multinationals. And now the UK is a jurisdiction that is attracting companies. I mean, when we have a U.S. company that's combining with a non-U.S. company, and the CEOs ask, where do we put the headquarters of this company? The UK is at the top of the list.
Mm-hmm. Yeah, just with respect to trapped cash, we really need to distinguish the past and the future. In the future, there will be no trapped cash. Whatever this committee does, it will not replicate the bizarreness of the current system in that respect. So the problem with trapped cash is entirely a problem with respect to the past. And there, again, we have to remember the reason why we have $2 trillion of trapped cash is that firms are hoist by their own petard. They have been so successful at stateless income generation. They have so much income that's been taxed at 5% or less effective rates. Those aren't competitive rates. There are no countries in which firms actually do business that have 5% rates. Those are the results of aggressive tax planning. And that success at achieving extremely low effective tax rates creates the problem and explains the $2 trillion. Again, this is the only time that I believe that this committee, at least in my lifetime, will ever confront an efficient tax, a tax that is efficient. It's efficient in the sense that it does not have any adverse behavioral consequences. There is no reason why the old cash should come back at preferential rates. The old cash should come back at a sufficient rate to pay for reform because going forward, you will have moved into a new system with completely different behavioral consequences.
Thank you. I yield back.
Thank you. Mr. Becerra.
Thank you, Mr. Chairman, and thank you to all of you. And Mr. Kleinbart, great to see you here. I hope you don't penalize us for our weather here. I know you're going to head back to sunny Southern California, and I plan to join you soon, but just wait a minute, the weather will change. A couple of quick points. First, Mr. Kleinbart, I think you mentioned that while I think there's full agreement throughout the room here that the system for taxation for all of our business community, whether foreign or domestic, has problems. Can you focus a bit on the domestic issue that we have with our corporate tax system or business tax system, not just corporations, for all our businesses?
Yes, I think we have two structural issues in the United States. The first is that the U.S. is the only large economy where a large fraction of its business income is outside the corporate sector. That's unique to the United States. We have more than half of our income now, business income, is earned by unincorporated businesses. Some are small, but some are also very large. Second, we have the worst of all worlds. We have a high statutory rate with sort of middle of the pack effective rates of what we actually collect. Those statutory rates lead to all sorts of tax avoidance behavior, tax planning work that people, like my former life, Paul, we should all be put out of business. And at the margin, distorts marginal decision making. So it's really important to get a lower rate. That makes the U.S. Corporate rate, that gets the U.S. Economy to be more efficient. It leads to better allocation of resources, and it leads to more investment in the United States. And again, it's not just U.S. people investing in the United States. It also makes the U.S. a more attractive environment for foreign investment to come into the United States.
And most of the discussion we've had today deals with our treatment of foreign earned income by corporations.
That's right, sir.
But if I recall correctly, a statistic from the Small Business Administration, 99%, actually 99.7%, I believe they say, of all employer firms in this country are small businesses that are unlikely to be corporations, or at least corporations that do business abroad and have a large percentage of their income coming from foreign activities.
The second part is almost certainly true. The first part is going to pose a very interesting question. When you lower the corporate rate, when you clean up the corporate preferences and create a more attractive business environment, what will unincorporated businesses do?
Right, so we're 99.7% of all the companies or firms in America really aren't going to benefit directly, immediately from something we do with the foreign earned income. They may ultimately and indirectly, I think there's no doubt about that, because what affects AT&T or some multinational company will obviously affect those small firms that do business with AT&T. But when we talk about the the taxation of foreign earned income, we are essentially not talking to about 99.7% of the companies and firms that are here in the U.S. And I think we have to recognize that they have a great interest in having a workable tax system as well. And so we have to recall that all those businesses today that are hiring Americans are likely not part of the conversation we're having with regard to foreign earned income. Can I move to another subject, and that's this whole issue between worldwide versus territorial rates for the treatment of foreign earned income. I always am amused by those who talk about us accepting the territorial treatment of foreign earned income, but folks put the period after talking about the territorial rate that a country uses for treatment of that income by those companies based in those countries. I'm wondering if those who advocate for territorial tax rates for multinationals would argue that the U.S. should adopt the rest of the tax system or regime used by those countries that have a territorial rate. And so I did a quick little Googling with looking at Wikipedia, and Mr. Osterheist, to respond to some of the companies that you mentioned. You mentioned Nestle's, I guess I got Nestle's, Novartis, Glaxo, Lenovo, Samsung. Glaxo is based in the UK. Their tax revenue as a percentage of GDP is 34.3%. That beats, they're collecting more tax revenue than we are. The U.S., the OECD looks at us at having 24%. So the UK collects more in taxation than the U.S. does. If we go to a territorial rate, which reduces rates for companies, someone's going to have to make up for that. And what the UK does is they make up for it income taxes, national insurance, VAT tax, and I'm wondering if we would be prepared to accept all those other tax regimes along with a territorial rate when we talk about a territorial rate. So that's food for thought. Maybe at some point, Mr. Chairman, we'll have an opportunity to discuss that. Yield back.
Ms. Jenkins.
Thank you, Mr. Chairman. Thank you all for being here. The OECD report calls for a renewed focus on risk allocation. According to the report, the transfer pricing guidelines are perceived by some as putting too much emphasis on legal structures, for example, in contractual risk allocations, rather than on the underlying economic reality. Some have proposed moving away from the principle that risk may be allocated among entities by contract and towards the principle that significant people and functions are determinative in allocating profits. One potential downside is allowing countries to recharacterize transactions based on some sort of economic substance claim, as a result could very well be created or create an incentive to move people and jobs offshore to low tax jurisdictions. So for all of you, in your view, are there specific areas where the current guidelines produce undesirable results from a policy perspective, and do the current OECD transfer pricing guidelines place too much emphasis on contractual risk allocations rather than the underlying reality of an economically integrated group? Mr. St. Amand.
Thank you, Madam. Indeed, in the area of high-risk activities, or highly mobile activities, or intangible, and we all know that the value now is, the value chain, it's on the intangible that the value is. The transfer pricing guidelines can be put at jeopardy or are failing in a number of circumstances. And it can be serious because what businesses need is security. They need to know, they need certainty. They need to know what the tax regime will be. And if a number of countries depart from the international consensus there, the risk we face is that they will take unilateral measures, they will take their own interpretation, and this will be chaos for business. So what we're trying to do is to recognize the difficulties of the arm's length principle, which too much relies on some legal arrangements in the activities you have precisely described, to tackle this and make sure that if you have in a very low tax jurisdiction 2 men and a dog to deal with all the intangible of a highly sophisticated multinational, whether American or European or from Asia, this would not work, and all the profits cannot be located without regard of where the intangible has been developed. So this is part of the action plan that we are developing. But again, this is to protect the consensus and to keep the certainty to all the players, tax administrations, but also companies.
Thank you.
I do think that a fundamental problem with current concepts of transfer pricing and of the exploitation of intangibles is the empty formalism that we allow to drive results. This is how we get to stateless income. It is by treating as real contracts between a company and a subsidiary, where that subsidiary is nothing but the alter ego in practical economic terms of the parent itself. Looking forward, the OECD discussion draft changes the calculus. It says, if you want to be treated as the owner of an intangible, you've really got to have independent business substance. You've got to be the one that does the R&D, the subsidiary does itself. We have, and I think that's the right answer. I appreciate the concern that that means that tens of thousands of high-priced engineers will now move to the Cayman Islands, but I also appreciate that in reality that won't happen. That, you know, I spent years trying to get securities traders to move across the river to New Jersey. I couldn't get that to happen. With all respect to New Jersey, it's just how they work. So the problem is a very serious one. We actually have in the code, in 954H, we have today a rule that requires that. Oddly enough, it's for banking income. And banking income is not the source of all the problems that we talk about because the rules require the human carrying out of all the relevant human activities by the CFC itself.
Could I
just briefly? Yes.
I disagree with Ed on a portion of this. If we are not going to recognize where expenses are incurred, then we are moving away from arm's length pricing, and we should just be candid about that, because in the real business world, who's bearing expenses is one of the most important determinants of who gets the income. And yes, from a group point of view, that fact that one entity is bearing it at the Irish tax rate rather than another entity is bearing it at the U.S. tax rate, and it's being deducted in one country versus the other, that from a group point of view doesn't matter that much, but from a country point of view it does. If we want to move away from that, what we are moving to is what you might call a factor apportionment system, where you're allocating the income based on factors. And if you move them, if you have the income allocable to where the jobs are, you are going to have some of those jobs move over a 20-year period when you have this in place. That is just going to happen. It may not happen overnight. You're not going to pick up 80,000 engineers and move them overnight. It's not going to be a giant sucking sound, but it will happen, and you have to be careful. And that's why in my paper I suggest if we want to move away, that we move towards more of a destination-based income tax where the intangible value is allocated to where the sales are, because the sales are not movable. The sales are the least movable aspect of economic activity.
All right, thank you. Mr. Doggett.
Thank you very much, Mr. Chairman, and thanks to our witnesses. I certainly take the same pride other members do in the creativity and product development and the success of large American companies. We've got many of them with major operations in Central Texas, and we're glad to have them there. But I think we can applaud and encourage that success without maintaining a view that because they are successful and they are big names, they're entitled to special treatment in the tax code not accorded to other businesses and individuals. The real question today about all of the fine print and complicated discussion that we've had is whether or not small businesses and individuals ought to bear a greater part of the tax burden so that some of these large brand name multinationals can pay less. I like a good cup of Starbucks just like the next person, but I also enjoy my coffee when I get a chorizo plate at Joe's Bakery or when I have a breakfast taco at Patty's Taco House in San Antonio, or when I go by and pick up my cleaning at Estrada Cleaners. And those companies, those small businesses, they don't get the kind of tax breaks that are available for these multinationals, and a system that accords General Electric a lower tax rate than the people that clean up the corporate boardroom at General Electric, I think is really offensive. What we have here is massive tax abuse, outrageous tax abuse by large multinational companies. And I think the second major question before us today, amidst all the minutia, is whether or not we want a tax code that encourages the export of American jobs overseas. If we have a system that says to a company that is looking to invest in either San Antonio, Texas, or South Africa, or Europe, or Asia, that if they invest abroad, they will pay nothing on the earnings from that investment, but if they invest here, they will pay 20, 25%, even 10 or 15%. The incentive is to encourage the export of those jobs overseas. And I think another question before the committee is whether the problem is just with the laws or with the companies, as was suggested in the opening remarks, as if the two didn't have something to do with one another. 30 companies have paid more to their lobbyists than to the United States Treasury in taxes, and I think they made a pretty thoughtful investment, because when you look at this tax code, it didn't just come down on tablets. It was the result of the determined lobbying efforts by some of the same companies that are here today asking for tax reform to make our system more complex if it helped them to maintain the minuscule level of taxes that they were already paying. Indeed, this committee and the Senate Finance Committee, if anything, facilitated, enabled, and created that tax code, and but for the work of the Permanent Subcommittee on Investigations under Chairman Carl Levin, and some impressive investigative journalism from several journalists, we would not even know about the extent of the abuse that is occurring in America today and shifting that burden to individuals. Mr. Kleinbard, as I listened to Mr. Oosterhuis's, or really read his testimony, I got the impression that if we had more cost-sharing agreements like the one Apple has, that we'd be better off. As I understood the testimony before the Senate Investigations Subcommittee, Apple developed, I guess with research and development tax credit, products here that it assigned 60% of the rights to Irish companies, and on $74 billion of income, it assigned that to the Irish subsidiary with profits taxed at less than 1%. Do we need more cost-sharing agreements like that?
I think Paul and I obviously part company quite dramatically on this point. I do not see cost-sharing agreements as a solution. I see them as a core part of the problem. Again, when you look at the international tax questions, there really should be a tug of war in your mind between the United States as the residence country, as the place where, say, intangibles are primarily created for a U.S. Firm on the one hand, and the market country on the other, where those intangibles are exploited, where the products are sold. Who gets how much? It's a tug of war. What cost-sharing agreements as currently practiced do is siphon money off between the two legitimate claimants, between the home country and the market country, to nowhere. That's why I call it stateless income. That's what Apple demonstrates. That is not income that reflects doing business in Ireland or anywhere else. The income that is being taxed under the cost-sharing agreement at essentially close to zero rates is income that has been siphoned off either from the United States, which I think is the case in that particular example, or from the market country. So unless you radically change how cost-sharing agreements work, along the lines of what the OECD has actually proposed, which is to require a firm, before it could even claim that it's part of a cost-sharing agreement, to do all of the work, as opposed to just contract right back to the U.S. parent to do the work. It's a meaningless operation. It's a subsidiary that purports to take on risk. That's no risk shifting. the parent ultimately bears all the risk because it owns the subsidiary. There is no risk shifting going on, there is no independent decision-making going on, and there's no independent ability to act going on.
The gentleman's time has expired.
sorry.
Mr. Marchand is recognized for 5 minutes.
Thank you, Mr. Chairman. Question for Mr. St. Almonds. Can you describe to us the trends in the OECD countries on corporate tax rates since the U.S. lowered the corporate tax rate as a part of its last big tax reform in 1986?
Thank you, sir. Indeed, the US and the UK in the mid-80s started the trend of reducing corporate income tax rates. And this trend has been pursued by almost all OECD countries, except the US, which now has the highest rate. The average rate in the OECD is around 24% for corporate income tax. The US is at 35 plus the state taxes. So the average is around 39% in the US. There is a distinction between small open economies and bigger, less open economies. And usually the rates in bigger economies will be higher than in the small open economies. If you take Germany, you are at around 30%. France is at 34%. But still, the trend has been to reduce the rates in all OECD countries. And Japan, which was quite high, higher than the US, has recently, last year, changed its rate to reduce it.
And of the OECD countries that have the lower rates, do all of them have a VAT tax as well? Or is the U.S. the only?
The US is the only OECD member country not having a VAT system.
So if you take the complete tax picture into account in each of these countries, is there still a very large gap between the actual tax bill of the companies versus just simply the corporate tax bill?
This would assume that VAT is borne by companies where, from an economic perspective, it's more borne by the ultimate taxpayers who are the consumers. So I'm not sure we can bundle both corporate income tax and VAT.
Okay, so any comparisons throwing the VAT in distorts that whole equation, in your view?
Indeed.
The U.S. worldwide system taxes U.S. tax-based companies on the profit of their foreign subsidiaries. Most of our major trading partners exempt that kind of income. If the U.S. converted to a pure worldwide system, wouldn't that provide a tax incentive for foreign companies to buy U.S. companies? And that's a question for all the panel.
Maybe I can start providing the following response. You have no pure system, or it's quite exceptional. I mean, Hong Kong, which was referred to earlier, has a pure territorial system, but it's quite exceptional. But in most of the European countries or Asian countries, Korea, Japan, when they have a territorial system, it's a territorial system with teeth, which means that you will be taxing some of the profits made offshore when they are taxed at very low rates. And when you have a worldwide system, as you are having here in the US, you have exceptions, which allows actually companies not to pay their taxes because of deferral or because of other mechanisms, not to pay. So you have hybridity almost everywhere, and you have no such thing as a pure system. So what matters, I think, is the way you will design either of the system you can opt for.
I talk too much.
But it's absolutely true that if we went to a worldwide system, and indeed today with our deferral system compared to the system in countries like the UK, like the Netherlands, like Switzerland, when deals are thinking about being done, when companies are thinking about combining and they are incorporated in different countries, it's rare for them to think of using a U.S. company as a parent. And that's because it would subject the earnings of the non-U.S. company to the U.S. tax regime, overlaid on their own tax regime, and that would clearly be a detriment to the synergies of the that the transaction is intended to accomplish.
The problem is what Paul says about current law and current business practice is true, but the question is how will people behave in the new regime? If you had a worldwide tax consolidation with a low rate, then the incentive to be not a U.S. corporation would dissipate. So we really have to project forward to a different regime to answer that question appropriately.
The gentleman's time has expired. Mr. Blumenauer is recognized for 5 minutes.
Mr. Kleinbart, I would like to explore one element here. We've had reference to how individual countries would like to have tax advantage for their own enterprises, a little home field advantage, or maybe a lot of home field advantage with patent box or whatever. But I wondered if you could just take a step back and help us visualize what would be the dynamic for countries across the board if we could have some mechanism that agreed to a 20% rate, a 25% rate, a uniform rate. Is it conceivable that the top 10 economies of the world, where most of the business is being transacted right now, that they would end up substantially ahead?
A couple of quick thoughts. For 100 years or so, we had this problem in the world of trade, where countries tried to get a leg up through trade subsidies. And finally, countries wised up, and we have GATT today, the General Agreement on Trades and Tariffs, and countries act together. Ultimately, what's going on right now, I think, in countries like the UK, is, in effect, a trade war being conducted through the guise of the tax system. And that is unhealthy. But the truth is that if you look at the OECD data, corporate revenues from major economies, corporate rates from major economies, in fact, converge towards a point. And that point is in the neighborhood of 24 or 25%. So European countries in particular have gigantic revenue problems. They have deficits. They have all the same problems the United States does in that respect, but more so. A 24, 25% rate is more or less the norm without the formality of a GATT-type process. And that, I think, is a much healthier environment for everyone to be in, is comparable rates across the board, and then firms make their decisions based on pure business considerations.
But the issue that I'm wrestling with, I mean, everybody ought to be concerned about income that doesn't have a home, that simply there is no tax liability. And as you pointed out, if Starbucks can figure out a way to do this, anybody can, although Starbucks found a way to classify pouring coffee as being manufacturing, and they ended up getting $88 million tax break in 2005. But isn't everybody going to be facing this ultimately? That unless we reach some sort of accord, people are going to gravitate because they can, putting aside the morality of it, or if they have a fiduciary responsibility to do it, they're going to do it if they make a substantial amount of money.
Yes, and that's what the OECD is all about. I mean, the OECD is the best organization today to try to get to consensus on the kind of issues you're concerned with.
Is there a way to formalize some of this in your judgment in the context of treaty negotiations moving forward?
Yes, absolutely. We have exactly that experience in the trade area with GATT, with the General Agreement on Trades and Tariffs. So we have experience in this area.
If I may shortly, one of the challenges in the tax area is that tax is at the core of sovereignty, and this cannot be overcome anywhere, and so be it. So what we are trying to do as the OECD is to get the countries speak to each other so that they respect their sovereignty, but there is some form of leveling the playing field on the one hand, and on the other hand, limit the frictions in terms of double taxation, but also limit the gaps in terms of double non-taxation, and that's where we bring all these countries, which are sovereign. At the end of the day, they will decide for themselves, but they cannot ignore the spillover effects on the others, and bringing them together is a way to limit such risks.
Thank you very much. Thank you, Mr. Chairman. I hope that this is the beginning of a series of hearings that we can do a deeper dive on this. I've enjoyed the informal operations that we had with the working groups, but I think there's value to the committee to continue this, and I hope this is the first of several.
Thank you. Mr. Reed is recognized for 5 minutes.
Thank you, Mr. Chairman, and to the panel, I really do appreciate your input and information on this, and I heard at least some unanimous kind of positions that were being taken, and one is that we need to do something, that maintaining the status quo doesn't work, and that's good. I also kind of got a sense of, when we were talking in response to my colleague from Washington, Mr. McDermott, that when we looked at the repatriation holiday history, and one of the lessons I'm taking away from that, having not been here, was that if you do it on a temporary basis, you're going to get different behavioral outcomes as opposed to if you do it on a permanent basis. So I think I got a sense that there's a broad agreement to do it on a permanent basis versus a temporary basis. The one thing that I'm very interested in exploring a little in detail with you is I firmly believe in the innovation economy, but I also believe that we can have a manufacturing renaissance here in America again. I'm the eternal optimist, and I believe it can happen, though. And so we'll continue to work for it. So as we look at option C from the chairman, Mr. Oysterhouse, I'd be interested in how do you see option C promoting manufacturing in America? And give us some input on that, and then we'll maybe open it up to other portions of the panel.
What option C does is, by providing a lower tax rate on the intellectual property element of value in exported products, it allows exported products then to bear an aggregate tax rate that is similar to foreign manufactured products. So it levels the playing field between U.S. and foreign manufacturing. Now, it does it by giving a deduction for a portion of the IP profit. There are other ways you can do that, I think, and there may be some ways that would raise fewer trade concerns than what Camp Option C has. But the point is that Camp Option C says we're not going to go to a 25% tax rate on the foreign manufacturing for foreign markets, because that has a serious competitive impact on U.S. companies. And instead, given that, and then we're going to tax it at a lower rate, then we want to also reduce the tax rate on exports so that U.S. factories can compete with offshore manufacturing. And that would be an improvement over the situation that we have today.
Mr. Sainam Mons, do you agree or disagree with Mr. Osa's assessment on that? And if so, why?
It's hard for me to meddle in the domestic debates between the options, so I don't really have a comment except the general comment that you have no pure system such as a worldwide system or a pure territorial system, so it's up to the U.S. to decide which one you would like to take, knowing that intangible clearly is where the value now is located in the value chain, and many countries are introducing patent box. That's just a fact that I can bring to you. The UK being the latest one having introduced such a patent box. The Netherlands has done so recently. Switzerland has a plan to do this. It doesn't mean that it's the right way to follow, because it has some implication also in terms of tax competition. Within Europe, there is a debate on whether patent boxes are right things to do or so, but I have no personal nor official view to share here with you.
Well, I appreciate you dodging that one. Mr. Kleinman?
You know, we do have today an incentive for manufacturing in Section 199. We do have a special tax rate for domestic manufacturing. You know, I would love to see a renaissance of domestic manufacturing. That's why I think reducing the tax rate to 25% with a broader base is really an urgent priority. It'll bring foreign investment into the United States, among other things, which we tend to forget about. But I don't like trying to pick winners or losers, and I don't think that the tax system should be designed with the premise that we're going to subsidize in some way one sector of the economy as opposed to another. Let's get an efficient tax and get tax out of the business of business people and let them get about their business.
Well, and I appreciate that input. So we have another general sense of agreement. Lowering the rate will bring that opportunity for manufacturing here in America. And I see my time's expiring, so I guess with that, I'll yield back, Mr. Chairman.
Gentleman from Wisconsin, Mr. Khan is recognized for 5 minutes.
Thank you, Mr. Chairman. This has been a very enlightening hearing. I want to thank our witnesses for your insightful testimony today. Mr. Kleinberg, just picking up on the last point, because I do share my friend's focus on domestic manufacturing, and this is true for all the panelists if you want to weigh in. I'm assuming that implicitly, because you haven't addressed it in your written testimony or even today, that there should be no distinction made between tradable and non-tradable jobs when it comes to comprehensive tax reform or the impact on the domestic manufacturing base?
Right. I start from the premise that we want to have a neutral business environment in which firms face a consistent tax rate and then let business go at it. So I don't make any distinction between the two.
Well, let me ask you this then. Obviously, any form of revenue collection system is meant to basically fund the basic government functions. And the reason this is so hard is we're trying to avoid blowing another hole in our budget deficit. So the goal of trying to reduce the rates and simplify, broaden the base, has to be paid for. And that's what is so difficult. That's why we don't have a plan on paper. And here's my concern, and I've been wrestling with this in regards to territoriality and the impact in that, is we always seem to be playing catch-up internationally with the OECD nations, what they've done in the last decade or so in lowering their corporate tax rate. But they've been in a unique position of being able to dial up their VAT in response to a reduction in revenue on the corporate side. We don't have that option. And so we're going to have to look at expenditures within the tax code in order to eliminate, in order to pay for the reduction somewhere else. And many of those expenditures on the seaside especially have a direct impact on domestic manufacturing. The 199, Mr. Kleinberg, that you just cited, depreciation, R&D. Those are the big ones. And so if we're going to get to a 25 level, chances are we're going to have to go after them.
Yes, sir. I think that's correct, Mr. Kant.
Yeah. And do you think we've been operating somewhat in a vacuum by ignoring the VAT systems that exist in virtually every other OECD nation, Mr. St. Amans? I've noticed that their ability to reduce the corporate rate has also been coupled with their ability to dial up the VAT, too.
Thank you, sir. I'm not sure I would venture on the area of VAT, which is quite controversial, I understand, in this country. However, I would like to draw your attention to the fact that in spite of having reduced the rates of corporate income tax over the past 20 years, OECD member countries have seen the contribution of corporate income tax to the overall revenue collected increasing. So it doesn't.
Is that based on the corporate rate or all the taxes?
On the corporate rate. I mean, the corporate income tax contribution to the overall revenue has increased instead of diminishing, which results in some saying there is no base erosion and profit shifting. Look, the rates have reduced, but the contribution has augmented. Actually, it should have augmented further if you take into account the profitability of companies. And of course, you have cycles there following the crisis in 2008, you have a decrease. But overall, you can fund a tax policy reform which will be neutral or which can even bring more money to the revenue. So decoupling it from the...
And how much of that do you attribute to the teeth that they put into the territorial system that they've moved to?
This data is quite hard to interpret, so I wouldn't get into the details, but I think it's worth looking at it. The data is available to you, of course. This is official data from the OECD.
Right. Well, I just think, you know, and again, I'd be interested in following up with you that we do need to be somewhat careful in regards to the incentives that already exist for domestic manufacturing in the country, since those are the big ones
that we're going to really have to wrestle with if we're going to be able to lower the rate to a level that makes us competitive globally. And I think these companies are going to have to do their calculation, whether they can live with a simplified lower rate without the current expenditures that they're able to take advantage of. And I think right now, when we're trying to create more jobs domestically, I think there are important distinctions to be made between the tradable and non-tradable jobs that we see going on in the global economy.
Mr. Klein, one thing to sort of keep in mind here is that the United States is, in 2012, the lowest taxed country in the OECD. There is capacity for in our economy to raise more tax, but also, when you think about taxes and burdens on individuals and burdens on businesses, you have to remember, how does government spend the money? And other countries raise more in tax, but they then spend that money in much more progressive ways.
Well, and again, that's one of the great elephants in the room here, is we do as a nation have the obligation of financing the world's largest, most effective military that does provide a relatively stable and peace global market for companies to do business. No other nation is willing to step up to assume that obligation, so we have to wrestle with that obligation too. Thank you.
Gentleman from Indiana is recognized for 5 minutes. Mr. Young.
Thank you, Mr. Chairman. I thank all our panelists for being here today, offering your thoughts. It's certainly been a thought-provoking conversation with some divergent views on different things, and I think that's helpful in a public forum here. Mr. Saint-Amand, I have also appreciated your very much understandable efforts to try and avoid making much international news in your current capacity. So, you know, one of the benefits to being of lower rank within this committee is that I have an opportunity to sometimes respond to some earlier comments that were made and get clarifications. And I'd like to do that. First will just be a comment. There was earlier a statement made with respect to small businesses, saying that there seemed to be a desire among some to have small businesses pay more so that multinationals could pay less in this effort. And certainly, I don't share that. And for those that have those concerns, I think it's really important that in this country, in the interest of competitiveness internationally and domestically, we reform not just the corporate code, but also the individual code. But secondly, I'd like to talk about an exchange that was earlier made. I think, Mr. Kleinbart, it was directed towards you and related to the benefits of repatriating profits. You indicate, I think it's actually, again, thought-provoking, that so much of those monies that have not been repatriated are essentially already in the economy and benefiting American corporations in the form of purchasing shares or being available for investment in a banking system or whatnot. And was that an accurate characterization of your position? Very briefly, please.
Yes, in respect to the cash, in respect of the liquid
That's right.
permanently reinvested earnings. Yes, sir.
So then if I could get another perspective, Mr. Osterhuis, are there not benefits to having more liquidity, and not just in terms of sort of abstract economic liberty terms, but are there some economic benefits to having that money repatriated and thus allowing those who hold the funds to have greater flexibility to start new businesses, expand existing businesses, spend the money domestically, invest in capital equipment, thus leading to higher personal incomes, or is that something that you can speak to, sir?
Well, yeah, I absolutely can speak to it, and I do think it's, as I've said before, quite beneficial for repatriation to be able to take place. I don't want to overstate it. It is true, money's in bank accounts. They're largely in U.S. dollar accounts. Of course, our banks are not lending now, we know, so that money is just sitting on deposit with the Federal Reserve, and that offsetting some of their asset purchases. So it's not clear to me it's really helping the economy in any significant sense today. But the important thing is that it distorts corporate behavior. I see it all the time. If companies don't like to have excess cash on their balance sheet, they want to put it to productive use. Cash does not generate earnings. Cash generates very, very small earnings for them. What generates earnings for them are real assets. And So they bias, because the cash is abroad and they don't want to pay the tax to bring it back, they bias their investments towards foreign assets. That's just a reality of the system. It makes perfect sense. If you had to pay a 25% tax to buy something in the United States and didn't have to pay the 25% tax to buy something in Europe, of course you would buy something in Europe.
I'm going to try and tease this out further. I do want to be fair on this. It's an interesting exchange. Mr.
I
Kleinberg?
agree, and I agree with what Paul just said.
Okay. So in terms of growth of our economy, we would see a benefit to further repatriation here. It's not a net neutral issue. We want to make reforms within the code here that will lead to greater repatriation, because that will grow the economy. I think that was confusing in terms of the earlier testimony and some of the statements that were made. You know, in my remaining time here, I got 30 seconds left. I think I'll just yield it back and look forward to speaking with some of you offline. Thanks so much for being here.
Mr. Davis is recognized for 5 minutes.
Thank you very much, Mr. Chairman, and let me thank you, gentlemen, for the insights that you have conveyed. It's been a very interesting and productive, I think, discussion. In the last few weeks, we've heard a great deal about Apple and its taxes or not taxes, what it has paid and what it should have paid and should not have paid. I note in your testimony, Mr. Osterhus, you argue essentially that a company's profits should be thought to occur where its sales are. Apple's main activity is research and development. The actual manufacture of its product is outsourced, and 95% of the research and development takes place in the United States. Mr. Kleinbart, it seems that the business activity that is generating Apple's profits, even on offshore sales, is largely in the U.S., and that those profits would not be possible if not for the patent protection, educated workforce, infrastructure, and other public investments made possible by U.S. taxpayers. Would you agree?
I would. And this, what you're saying, Mr. Davis, is consistent with the point that I've been trying to emphasize, that we should conceptualize all this as a tug of war between the home country on the one hand and the market country on the other. The Apple case is a powerful case for why some tax revenues belong in the home country, not in the destination country.
Mr. Osterhus?
Yeah, two points on that. First of all, Apple is a company that spends about 3% of their revenues on R&D. That's relatively low. Apple is a company that's become fabulously successful because they had ideas that captured consumers. And a lot of that has to do with the consumer-facing side of the business, not the R&D side of the business. They were able to capture products that not only sold at premium prices, but that led to annuities of income when people bought movies, they bought books, they buy records, they buy all kinds of things that Apple gets a piece of. That is a terrific business model that they built. That requires real value in the countries where the customers are, because it's the customers that are paying those premium prices. If Samsung had done what Apple had done and was shipping its smartphones into the United States and charging premium prices, you know that the IRS would be saying the bulk of the value should be in the United States, even if it was invented in Korea. And that's the reality of it. There is tension between the two. My point in saying that the bulk of the profits should be in the market country is that that's the least mobile way to allocate the profits among the countries, and the best way to minimize the distortion of people moving jobs and moving activities around the world for tax purposes.
Then let me move on a bit, if I might, let me just, it's hard for me to reconcile the notion, and I certainly hear the argument, but I also note that you argue that the U.S. should not be too concerned if a company like Apple seemed to be avoiding taxes, that it ought to pay to foreign governments on its foreign profits. But once we recognize that much of the profits that Apple characterizes as foreign are really U.S. profits, because all the research and development that created those products took place in the United States, then I think that avoidance of foreign taxes becomes a problem. Mr. Kleinbart, you indicated that in your testimony, and I guess my question becomes, do you think the United States has a bit of self-interest in helping to protect the tax base of foreign countries?
I actually do, once we understand that foreign countries means the market countries. What we want to get to is the tug of war. The United States will win its fair share of those tugs of war. What we don't want is a case like Apple, where the income is not being taxed either in the market country or in the source country. That's the fundamental problem that the Apple case demonstrates, is that the income has escaped tax everywhere. Now, I think that income, in this case, is more appropriately taxed in the United States. I don't think that Apple is in the business like maybe a Nike of having different shoe models in every country. They're selling the same iPhones everywhere in the world. It's the same global platform. For that reason, I think the profits are in the U.S. Other cases, may be different, but we'll win our fair share of the tug of war. What we have to get out of is the idea that we will allow this siphoning off of cash to nowhere.
Gentleman's time has expired. Mr. Renacci is recognized for 5 minutes.
Thank you, Mr. Chairman. And I want to thank the witnesses, too. It's interesting, as Mr. Young said, being here at the end and listening to all the conversation, you get to kind of go back and rediscuss some of the issues. I'm still a little bit, I still question this trapped issue. Mr. Kleinberg, you had indicated, I know Mr. Young brought this up, that these earnings aren't trapped. They're coming back. They're in bank accounts. Mr. Ostrich, you're saying, I think you disagree with that, though. I want to just, can you?
I think Ed and I agreed that there's much more productive uses of that cash than sitting in bank accounts. And so if companies could bring the money back and have tax-neutral decisions on whether to invest it and where to invest it, that would be an improvement.
Right, because it's not being used by the company to put back into the business here in the United States, correct?
Or anywhere, yeah.
Well, right. My point is that the cash, the very large sums, perhaps as much as perhaps as much as $1 trillion, is in the U.S. economy, but it's not optimally allocated. Where Paul and I agree is that there is an incentive to use that cash to make foreign acquisitions. I think of Microsoft Skype, for example, as a perfect example when Microsoft bought Skype.
HP Autonomy.
Or HP Autonomy. I was trying to think of a more successful example.
The other thing that I thought is kind of interesting, I know one of my colleagues talked about the deferral as a tax break that causes companies to ship jobs overseas. I'm a CPA. I've had to look at tax consequences of many businesses. My question would be, is this really a tax break, or is this just something that's really part of an outdated tax code?
I think it's the latter. It grew up from the 1920s of the practice of taxing companies that were incorporated in the United States and not taxing companies that are not incorporated in the United States without regard to who owns the shares of those companies. It wasn't intended as a tax break.
I think of it as a thing, and when I was at JCT, one of the things I tried to do was to change how we scored that as a tax expenditure, and say, no, it's not a tax expenditure. It's just a thing. It's just a structural way we've chosen to do our international tax system. The right question is, what should the international tax system be? Whether you call this a break or you call it an outdated norm, unimportant. It's just a thing. It has economic consequences. We can do better than the current thing.
Mr. Oster, can you talk a little bit about, Mr. Kleiner, you said a 25% rate across the board is something that you believe in.
And it's right at the OECD norm. The OECD average is about, what, 24?
Mr. Oster,
24.
Where do you see that?
No, I think definitely too high. First of all, as I've said before, the statutory rates aren't the complete answer because of the incentives that are built into the systems in foreign countries to reduce those rates. The UK patent box at a 10% rate is a classic example. Their corporate rate will be going down to 20%, but they'll have a 10% patent box, so the effective rate will be substantially lower for high intangible value companies. Second, that doesn't say anything about earnings, about what Ed calls his stateless income or third country earnings. There's always going to be some third country earnings, whether it's in Samsung's system or in Glaxo's system or in Novartis's system, they're going to have that. So their effective tax rates, and those are the companies U.S. companies compete with, their effective tax rates will be lower than their local statutory rates by that reason as well. So if we're taxing U.S. companies at 25%, when those companies have tax rate, I mean, Lenovo's tax rate is under 20%, for example. Why should we give our companies that kind of competitive disadvantage? If we're gonna tax worldwide income, it needs to be at a low enough rate that it basically approximate the amount of foreign tax they will in fact pay, and that's between a 10 and 15% rate, in my judgment.
It's interesting. I know my time's running out, but the one thing I think everybody agrees to is we have to simplify this and we have to bring the rate down. And whether it's 25, 10, 15, it's got to come down. So I appreciate your comments. Thank you. I yield back.
Ms. Sanchez is recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank our witnesses for being with us today. Mr. Chairman, as you know, I recently sent both you and the ranking member a letter urging that the bipartisan task forces that process continue to the next logical step, which is trying to construct some policy. Because I think we need to and can get concrete bipartisan tax reform proposals on paper. And if we're serious about a bipartisan comprehensive tax reform, I think the task force working groups are a way to keep that process moving. And if we can do that, I think we can put together a fairer and simpler tax code that provides the long-term certainty that businesses crave and makes America more competitive in our global economy. Our hearing topic today arises from the fact that our current laws make it perfectly legal for huge multinational corporations to avoid paying taxes on mind-boggling sums of money. And while our statutory corporate rate may be the highest of any country in the OECD, the U.S. has the second lowest corporate taxes as a percentage of GDP of all the OECD countries. Companies with the resources to transfer profits and jobs abroad have an unfair advantage over truly domestic companies that do their research here, provide good-paying jobs here, and manufacture products in the U.S. And I think that leveling that playing field is long overdue. Throughout the task force process, our manufacturing group heard over and over again from domestic manufacturers that foreign governments aggressively offer research and development incentives and packages to try to lure them, their company's research and intellectual property overseas. We'd love to keep those innovative, high-paying jobs and the IP that goes with them in this country, preferably in Southern California. But I want to take my time to focus on domestic businesses, specifically manufacturers, who, as Mr. Kleinbard noted before the Senate's Finance Committee in 2011, are the truly disadvantaged actors in our current system because they can't engage in those base erosion activities that multinational corporations can. So my question is directed to Mr. Kleinbard. If we can close offshore loopholes and get this money back into our economy, what kinds of changes could we make to incentivize domestic manufacturing growth for companies that invest in high-tech R&D and manufacturing here in the U.S.?
Two quick thoughts. Whatever system you go to, if it's well designed, U.S. multinationals are going to pay more tax. And the only question is, will they pay it to the United States or will they pay it to foreign countries? So their tax burdens will go up. What choice can there be when their tax burdens on their foreign income today are measured in single digits? The question of domestic manufacturing is a very difficult one because, frankly, I am skeptical of the utility of tax expenditures in the form of R&D credits and the like. They're very expensive subsidies. and they're often poorly targeted subsidies because they go to firms that would behave in exactly the same way without the subsidy. So that's just money wasted by government. I would use all the revenue you can raise to lower the rate to whatever it is. 25 is my opening bid. If you guys can come in at 22, more power to you. Whatever it is, that's the way to go. The subsidies are just extremely expensive, and because they go to people who don't need them in the end.
A follow-up question on that. Do you prefer things like Section 199, which actually ties incentives to wages for workers?
You know, I'm not a fan of any of these programs, honestly. 199, as you all lived it, became a broader and broader concept as to what was included. Movies suddenly came in. Pouring coffee suddenly came in. The subsidy grew and grew and grew by virtue of the nature of the political process. I think it's the wrong direction. You know, the right direction, and you know, Mr. Ryan said this yesterday. We are drowning in tax expenditures. Let's not figure out which subsidies we should add. 199 distorts decisions as to what's covered, what's not covered, what's wages as opposed to investment in capital equipment that might lead to higher incomes in the future. The tax system ought not to be in the business of trying to steer the economy. We ought to do what we can to have a low, consistent business rate and declare victory and let business take care of business.
Thank you. Thank you.
Thank you. I'll go to Mr. Pascrell now.
Thank you, Mr. Chairman. The issue of the big multinational corporations like Apple reducing their tax bill into the teens by shifting their profits to offshore havens has been in the news lately, and we are all concerned, as we should be. I believe that this is an alert sign, that issue, to all of our attempts to reform the tax code. I believe it is very significant, more so than we think. We're coming out of one of the worst economic crises in our nation's history. Many Americans are playing by the rules, most Americans, and are still struggling to get by. That is not a question. That's data. When you see what happened after the Second World War up to 1973 in terms of productivity and return, when we still believed in sharing of wealth, and then what's happened from 1973, 1974 to 2011 and 12, where we stopped sharing the wealth, productivity increased, and folks were participating less in the sharing of it. So we've gone from a stakeholder society to a shareholder society. There are no two ways about it. That's the data. That's what it shows. And then we look over at corporate America, and we see these big companies, these big conglomerates, as we call them, whatever name we choose, and they are worthwhile in the society. That's not the question. Big accounting departments, changing, bending, exploiting the tax code. Average person doesn't have all of these folks at his fingertips to do these things. To make sure they're contributing as little as our size as possible. We're talking here time after time, Mr. Chairman. We talk here about how we're going to help corporate America. We have very few meetings about how our tax code can help the poor. Unless I missed any meetings I didn't know about.
Well, we did have a working group on exactly that subject, and including 10 others.
I think it's un-American, Mr. Chairman, if I can use those terms. I think it's a good word to describe it. So we need to fix it. So let me ask you, Mr. Clyburn, this question. Corporate taxes once made up about a quarter of federal revenues many moons ago. In fact, to the 50s, that was the case. And that is down to below 10% today. And that didn't just happen. I mean, just didn't, somebody woke up one morning and said, we better start changing this and moving things around. This government, our government of the United States, a representative government, changed the rules. Many corporations are now calling for further reductions in the corporate tax and a shift to so-called territorial system in order to keep this competitive. Do you believe, you personally, that this is possible to do in a revenue-neutral way? Will a shift to such a system lead to an increase or a reduction in the amount of corporate tax collected? And if corporate tax collections go down, what are the federal government's other sources of revenue that will go up to compensate? Who pays for them?
This is a very important question. For the historical pattern, we have to keep in mind that the United States embarked on a unique path of disincorporating business. So today, more than half of business income is simply not in corporate form, but it's still in the U.S. tax system. It's taxed through the individual system because we've gone on this unique path to disincorporate business in America. So that explains some of the data. My belief is, well, the JCT estimates will be what they are. And I think the tax rate has to be driven by that. There is a great deal by way of business tax expenditures that make no sense to me. You know, this is not the Soviet Union. We don't engage in Soviet 5-year plans for the economy. So we should get the United States of America, the government, out of the business of subsidizing individual companies or industries. That brings a lot of revenue onto the table to buy down the rate. And again, although it may not be generally appreciated, if you do a sensible job in this committee, whatever you end up doing, multinationals are going to pay more tax. The only question is how much of that does the U.S. grab as opposed to foreign market countries? And that's, you know, that'll be a very interesting question. Very interesting to see how JCT scores it. Finally, you've got the $2 trillion pot of old earnings. And I keep emphasizing, this is the only time that this committee will ever be confronted with the opportunity to have an efficient tax. You can tax those old earnings in the transition to the new system at a rate higher than 5% and sufficient to help fund the revenue costs of moving to the new system. Under no circumstances do I contemplate moving to a corporate system that is a net revenue loser.
All right, thank you.
Thank you.
And for our final member to question this morning, Mr. Kelly.
Thank you, Mr. Chairman, and thank you all for staying so long. I'm interested in a couple of different things, and we certainly have a lot we can talk about, but there's an old saying I remember. It goes something like, if you build a better mousetrap and the world will beat a path to your door. That's accredited to Ralph Waldo Emerson. But what he really said, if a man has good corn or wood or boards or pigs to sell, or can make a better chair or knife, crucibles or church organs than anybody else, you will find a broad, hard-beaten road to his house, though it be in the woods. Now, we're talking about tax strategies here. Now, you all understand it because you do it every day. But for the average American who relies on us to do the right thing for him, and talk to people like you to come to and answer this, a code that's 75,000 pages, that American companies and individuals preparing their taxes spend $168 billion, that's with a B, dollars to do the preparation, and almost 7 billion hours. Gosh, do you think that's a little difficult? So my question to you, as we talk about all this, it doesn't matter to me how we get there. But if our goal, our stated goal, is pro-growth tax reform, because what we're talking about, we need extra revenues. Where would you get them? Who pays taxes? People.
People pay taxes.
People who work? What kind of companies pay taxes? Only profitable companies. So if we create a tax code that's so complicated that drives them offshore and then say, these are bad folks. They're not patriots. They're willing to take their business offshore. It's not that they're stupid. It's not that they're unpatriotic. It's just that they're not stupid. We have created a system. Now, I have a lot of people that represent back home. They're in the host business. It means they have bars. you can keep customers out of your bar by raising the cover charge. And I'm suggesting that's what we've done. Now, if we're looking for revenue, and if we're looking for success, and we're looking for profits, then wouldn't the idea be that a government that is actually an advocate for your success and not an adversary, would that be a little better model? Now, when we talk about international tax code, why would we want to do this? This strategy is a huge part of every business's and every individual's life. My gosh, you got to look at it. And you got to hire somebody else to do it because it's too complicated. And the real fear is not that you're going to pay too much, it's that you're going to make a mistake, and somehow you're going to come under great scrutiny. Any place else in the world that makes it tougher than the United States? You know the international boundaries.
I have never done research on the individual compliance.
No, but you talk to companies all the time. Tell me why we're no longer one of the best places to start a business.
Well, first of all, you know, I'm now an academic.
Not to be disrespectful. The reason is it's too hard.
Well, I don't agree with the premise of the question that we're not one of the great places.
Well, I'm only going by the rankings. We're way down.
Well, the rankings, you know, there are a lot of interesting opinion polls. I don't think...
No, I'm not talking about opinion polls. I'm talking about hard facts. I'm talking about batting averages. I'm talking about completion yards after the catch. This is a tough place to start a business in.
It's
and
legendarily...
a government that's too big,
That's simply false.
It's not false.
It is simply false. This is the easiest country in the world in which to get in.
Then why are they not flocking here? Why are we going to Ireland? Why are we doing other things?
Because no country can compete with zero. That's simply the problem. The problem is that we've allowed a system in which companies are able to reduce their tax rates to zero or to single digits. That's not a rate that any actual economy operates under. Not the UK, not Germany, not France, not the United States.
I get you. But it still comes down to, usually people do business where it's easy to do business.
Again, it's easy to start a business in this country. You
Mr.
don't have to
Mr.
go to the
Clyburn, have you ever
police
started a business?
My wife did.
So just a yes or no?
I was a partner in a large in a business.
All right. Well, me too.
My wife started
I do own a business. I'm going to tell you right now. It's become so difficult, so heavily taxed, so heavily regulated. We are not the premier place to start. People are going elsewhere. Why would they not? This is the greatest market in the world. It's a global economy, Mr. Buchanan said. Shouldn't we be looking at establishing a tax code that's a pro-growth tax code that allows people to look at us and not just participate in the global economy, but dominate the global economy? My goodness, with all the natural resources we have, with all the advantages we have, I hate to be sitting there with a tin cup looking for other people to help us. We don't need to. We have been endowed by God with the greatest assets in the world at any time in the history of the human race. And we can't get out of our own way. We have gamed ourselves. So I appreciate you being here. Mr. Oster, I would like to get to you because I really admire what you said and understand. And Mr. Simon, thank you for being here. Mr. Chairman, I yield back.
Well, thank you, and I want to thank our witnesses. This is a very important hearing, and I very much appreciate the quality of your testimony this morning, and want to thank you for the contributions you've made to this issue. And with that, this hearing is adjourned.